Well, we hate to break it to you, but more than 6 in 10 taxpayers will face a tax increase in 2026.
I am so over the tax system that we have in the United States.
Why the do I owe over $2,000 in motherfucking taxes?
Are you paying more in taxes than the world's richest men, Jeff Bezos and Elon Musk? Surprise, surprise, you just might be.
Many of the wealthiest Americans pay little or no income tax.
Imagine working 3 months every single year and sending every cent of those paychecks to the US government. Well, guess what? You don't really have to imagine that because that's basically what you're already doing. You see, the average American gives up 25% or more of their income in taxes to the US government. Yeah, a quarter of your year gone before you even get to keep a dollar. And when I was a W-2 employee, that was just normal life. File, hope for a refund, repeat. Then I became self-employed. No one withheld taxes for me, I had to write the check. And for the first time, I actually saw the number that I was paying. It was no longer just a line on a pay stub, but it was a number on a check that I had to write to the IRS. And that's when I started asking myself, why is it that the wealthy seem to pay zero in taxes or close to it? Is that something that I could actually unlock as a regular 9-to-5 employee? And why does it feel like this information is so gatekept? Well, to answer those questions, we have to understand how the American tax system actually works and who it's designed to reward, which is what this 3-part video series is going to expose over the next couple of weeks. So you're going to want to stay tuned. There's a quiet divide in this country, and it's not rich versus poor. It's workers versus owners. This is the worker, okay? This is you. You earn a paycheck, you get taxed first, and you live on what's left. Now this is the owner. The owner earns, spends first, and gets taxed on what's left, if anything. So what does this really mean in layman terms?
Think about it this way. If you're a W-2 employee and you make $100,000 and you have $20,000 in taxes, your employer is going to withhold a portion of that throughout the year from your paycheck, and you can't do anything about it. If you're a business owner and you make $100,000, you can deduct $20,000 for payroll. You can deduct $10,000 for rent expense. You can deduct $20,000 for office expense. And then you get to manipulate what your net income is because you get those deductions.
So are you saying in that example, instead of having $100,000 of taxable income, if all of those expenses are $50,000, then you're really only paying taxes on the remaining $50,000?
Exactly. You get to manipulate what your net income number is versus a W-2 employee, whatever's paid to you, you're taxed on.
The tax code isn't punishment. It's a playbook. A playbook the worker isn't reading. It rewards behaviors the government wants more of. Build housing, create jobs, take risk, invest capital. And yet the worker's told that the system is fair. Work hard, pay your share, retire someday. Sound familiar? But what if the illusion of fairness is a trick? What if the real secret isn't to work harder, but to learn the playbook that the owners use? And somewhere inside that 7,000-page maze that the IRS calls the tax code, there's a single paragraph that flips the rules of the game. Because that paragraph quietly hands workers the keys to the owner's playbook. And it says you don't have to quit your job to become an owner. You just have to own the right kind of asset. And that's where real estate comes in. Specifically, short-term rentals. The IRS calls them short-term rental activities. Most people call them Airbnbs. Inside that same section of the tax code, the IRS offers a little gift to anyone who owns one of these, a concept called bonus depreciation, a mechanism that lets everyday workers start playing by owners' rules.
Bonus depreciation is basically a fast forward button on your tax write-offs. So instead of spreading your deductions over 39 years, you can take most of them in year 1 if you qualify.
And here's the crazy part. It was supposed to disappear. In 2024, it was actually being phased out. Then came what lawmakers nicknamed the Big Beautiful Bill, a massive, quite honestly divisive piece of legislation that quietly brought it back. 100% bonus depreciation reinstated. That single line in that bill unlocked what I believe is the greatest tax strategy of all time, because it gives W-2 earners a way to play like owners. You've probably heard people call it the short-term rental loophole. Well, loophole sounds sketchy, but it's not. I mean, it's written right there in the tax code. Own a short-term rental, and the IRS starts treating your income the way that it treats a business owner's.
And that's why it's so powerful. It crosses the line between passive investing and active business ownership. So when done right, your property income and your W-2 income start to offset each other.
Right. See, normally, rental income is considered passive, and passive losses, things like depreciation and repairs, cannot offset your W-2 income. But the IRS carved out one big exception. Why did I do big like that? One big exception. If your property's average stay is 7 days or less, aka the Airbnb business model, then it's no longer considered just a rental. Now it's a business. And if you actively run that business, you can now use those paper losses to offset your active income legally, which is, important. So let's run the numbers together. Let's say you buy a $650,000 short-term rental. You furnish it, design it, and you get it guest ready. You then get a cost segregation study done that breaks down your property into different parts. Things like flooring, appliances, furniture, and landscaping. Well, a good rule of thumb is about 25% of that qualifies for bonus depreciation, which in this example would come out to roughly $162,000 in immediate write-offs. On paper, your property lost $162,000. I feel like I'm doing like a lot of quotes in this video, but they make sense. So anyways, this is a paper loss, a deduction. If you're in a 30% tax bracket, then that's roughly a $48,000 reduction on your taxes in 1 year. Oh, and PS, if you already own a short-term rental and you want to reduce your taxes with the short-term rental that you already own, then head on over to strcostseg.com. You can go and input your own property details. We will give you a quick estimate of how much you can reduce your taxes by. And if you like the numbers, which you probably will, then you can always hire us to make the report for you. We are super fast. All of our reports are QA'd by actual engineers, and you get audit protection with every report. Again, that's strcostseg.com, and I'll leave a link for you in the description down below. And I'm telling you, once you see how much money that you've been handing to the IRS unnecessarily, you'll realize just how powerful this tax strategy is. But, of course, there is a catch. To play this game, you can't just sit on the bench. You have to materially participate in the management of your short-term rental. That means that you can't hand it off to a property manager. You actually have to run it. However, the IRS actually gives you a few ways to qualify. But the simplest one, if you work 100 hours or more a year on the property and no one else does more than you qualify. Doing things like answering guest messages, coordinating cleanings, doing the little maintenance runs, updating pricing, it all counts. If you hit those 100 hours or more, then guess what? You're no longer just a worker, you're now a business owner. And like I mentioned earlier, there are several ways to materially participate in the management of your short-term rental, 7 to be exact. So I actually put them together in this little guide here that you can download in the free resources section of my free community. And if you want this free guide, I'll leave a link for you in the description down below. So what happens when you, the worker, finally starts using the owner's playbook? Well, why don't we look at it side by side? In this example, our worker makes $100,000 a year at their job. And because of that, we're gonna say that they're in a 30% effective tax bracket. Every year, they end up sending the IRS roughly $30,000 in taxes. Now let's compare the two paths that you can take in real estate. First, a long-term rental. Our worker buys a $650,000 rental property, and it depreciates slowly over 27.5 years. However, it's passive, so those losses cannot offset their salary. And as a result, they still owe that $30,000 tax bill. Now, let's look at it from the short-term rental perspective. Same house, same purchase price, but they run it as an Airbnb, get a cost segregation report done over at strcostseg.com, and take advantage of bonus depreciation. That report finds that they are eligible for a $162,000 paper loss, which would then wipe out their entire $100,000 of taxable income. So their $30,000 tax bill, gone. You can do all of this in year 1, but what happens if your paper losses are actually larger than your salary? Do you just lose that?
Yeah, so here's where it gets crazy. In your example of your W-2 employee making 100 grand, but then the paper loss is 162,000. So they would use 100,000 the first year to wipe out their tax bill. And then that 62,000 they would carry over to the next year. So if they make another 100 grand the next year, they're only gonna have $38,000 of taxable income because they got to carry forward the loss. So you don't lose it.
Man, that's kind of nuts. So how far can you even carry it forward?
Technically, indefinitely, forever.
So to give you another way to look at this, let's say that you put $130,000 down to buy the house, or 20% of $650,000. And let's say because of bonus depreciation, you are able to offset your income by $30,000. Well, to buy your property, it's as if your true out-of-pocket cost was $100,000, not $130,000, because again, you reduced your taxes. Because you didn't just buy a property, in a weird way, you sort of bought yourself out of taxes. For everyone at home, are there any gotchas with this loophole and this tax strategy?
So yes, it's called recapture, meaning that if you sell the property that you bonus depreciated, you'll likely pay some of that back, and most people don't keep that in mind. But with the right tax strategy, you can keep kicking the tax can down the road.
And when I first learned this, it turned my whole world upside down. I realized that the real villain wasn't the IRS. It was the illusion of fairness. We were never taught this playbook, especially not in school. We were taught to believe that hard work alone would set us free. But no one tells you that the system doesn't reward hard work. It rewards ownership. And once you see that, you can't unsee it. And in the next episode, I'm gonna show you how this same strategy snowballs. How one property can erase your taxes year after year, and what I call the Zero Tax Snowball. It's gonna be a good one, and you can watch it right here. But first, don't forget to, like and subscribe so that you're notified when this video is live. All right, see you over there.